Hello and welcome back. If you are new here, welcome. My name is Jessica Abella. I am a tax and small business advisor, and today we're going to spend just a few minutes chatting about paying yourself if you are a business owner. We're going to talk about how to pay yourself if you are taxed as a sole proprietorship and how to pay yourself if you are being taxed as an S corporation. We're going to leave C corporations out of the equation at the moment. Those are pretty rare in the small business field at the moment, but definitely drop a comment if you would like information about that. And then we're going to chat about a couple of strategies on how to determine how much to pay yourself. So first, if you are taxed as a sole proprietorship, and so this is the business owners that are formed as a sole proprietorship or that have an LLC that you are the only member of and you have not elected for your LLC to be taxed as something else. So in that case, you're taxed as a sole proprietorship and there is no formal process for paying yourself. You can just write yourself a check from the business. You can transfer funds from the business account to your personal account. The nice thing about that is that usually the bank statement shows what account that money went to, so it's usually pretty clear. And in your accounting system, you're going to choose that is an owner draw, or QuickBooks Online often creates a category called Owner's Pay and Personal Expenses. So you're just going to transfer the money out of the business, you're going to code it as a draw, and that's it. Remember though that you are going to pay tax on, theoretically, roughly 30% of profit. That's the number that we tend to advise for small business owners to set aside. So as you are draining the bank account of the business to pay your personal expenses, keep in mind that 30% could need to go to the IRS. So be sure to be saving money for taxes. Now, if your business is taxed as an S corporation, so either you're formed as an S corporation or you're formed as an LLC that has opted to be taxed as an S corporation, and you are the owner and you are working in the business, you are required to be on payroll. You are required to take reasonable compensation from your business in the form of payroll. Now, reasonable compensation isn't exactly defined with the IRS, but it does need to be reasonable to the market, to how much money the business can afford to pay you. If the business can't afford to pay you anything, it's completely reasonable that it pays you nothing. But if the business is making money, it should be paying you something equivalent to what you would be paid if you were working for another company or if you had to bring someone in to do the work that you do in your business. There are some tools for that, so definitely feel free to reach out if you need tools for that. One thing that we hear from business owners sometimes that is a myth is that they have to set their salary and stick to it, and that's not true. Certainly as the business owner, you bear the burden when business is not doing as well. So if you have a month where profit is down and cash is down, you may take less that pay period, and that might mean that you take more in a future pay period, or if the business is doing really well, you might take a bonus later. But that payroll can vary from pay period to pay period. It does not need to be a set salary throughout the year. Now, as an S corporation shareholder, you also, in addition to your reasonable compensation or as a part of your reasonable compensation, you may also be receiving reimbursements from your business for the business mileage on your vehicle, for use of your home office, if it's for the convenience of the company that you have your operations at home, any other reimbursements that are reasonable for business. Those things are also opportunities for you to get cash out of the business. And then the third way that you get money out of the business as an S corporation shareholder is as distributions. So much like the owner draw at the sole proprietorship level, you're able to take some profit from the business just as a distribution. That is still taxable. So keep in mind again that you need to be setting funds aside for tax, and working with a reputable tax professional should help you determine what those percentages should look like. Now, when you are trying to figure out how much to distribute from the company, right? Whether we're talking about owner draws or we're talking about your wages, your salary and distributions, there are two different strategies that I want to chat about here briefly. The first one is the Profit First method. It's a book, and I will link it down below. And the Profit First method is looking at your revenue first. So every dollar that comes in the door to the business, you are going to parse out into a percentage for your owner profit and a percentage for operations and a percentage for taxes. So every dollar that comes in gets parsed out into different buckets so that you know exactly how much you have available to distribute to yourself, how much you have available to pay taxes with, and how much you have available to run your business, so for operations. There are some banks like Relay that will even do that automatically for you. As money comes in, it will do that percentage for you across different accounts. It does limit the funds available for operations so that you can only spend what cash you have available there. So it can be a really good strategy for reining in your spending. So it's certainly something to consider. The other is the flip side, to look at the profit. So after your business has paid all of its expenses and you've got profit at the end of the day, maybe you take a percentage of that, setting aside or planning to accumulate your emergency fund for the business. Always a good idea, no matter what your strategy. So, if your business profit and loss at the end of the month says you have a $10,000 profit, you may decide to set aside $3,000 for tax, $2,000 for savings, and $5,000 for yourself. However you determine that, you may decide to determine it based on profit. The downside, of course, to that is that if the following month you have a loss, now you don't have any cash to deposit or to draw from that following month, and you may need to put some money back. So definitely having that emergency fund is important for cushioning those low cash flow months. So I've mentioned taxes a couple of times. I just really want to circle back to the idea that with both of these entity types, whether you're a sole proprietorship or taxed as an S corporation, your profit is taxable in the year that it is earned, regardless of whether it has been distributed to you or not. So as an example, if you start a business in December 2024 and the business brings in $10,000 and doesn't have any expenses, we're keeping this really simple. It opens a bank account, you receive $10,000 in revenue, and in 2024 you're going to pay tax on that $10,000 of revenue. In 2025, when you take that $10,000 out, you're not going to pay tax on it again. You already paid tax on those dollars. So just to keep that in mind, the dollars are not taxed twice, and they are taxed even if they're still sitting in the business account at the end of the year. So keep that in mind. Are there any questions? I feel like there's an opportunity for a lot of questions in this topic, so please put the questions down below or drop me an email. I would look forward to addressing those either in a future video or directly. If you have ideas for other videos, I'd love to hear them. If this was helpful, please click like, subscribe if you haven't already. Have a wonderful rest of your day, and I'll see you back here next week. Bye.